All right, and we are back. So today there was an enormous amount of things that happened both in markets and with meetings, with the Federal Reserve meeting, with the emergency G7 finance minister and central bank conference call meeting. And I'll talk about the real reason, in my opinion, why there was an emergency G7 and emergency central banker conference call meeting, and you could see it on your screen, hint, hint. This came from last week. I haven't seen that many people talk about it. I have a number of stories I've been collecting over the last week to 10 days, connecting the dots for you, so I will do my best to, as efficiently and easy to understand as possible, try to connect the dots about why the emergency meetings occurred today. But first, let me just talk about the rate cuts. So we got the 50 basis point rate cuts today that former Minneapolis Federal Reserve Bank President Naranja Kocherlakotla lobbied for in his, there's the right word, lobbied for, in his Bloomberg op-ed last week. So he called for at least 50 basis point cuts immediately, and we had all that stock market volatility last week. So we had the stock market down enormously last week, the 3:44 p.m. Eastern Time magical unicorn rally where not-for-profit buyers came in and bought the stock market rally to try to paint the tape to make the stock market look better. Yesterday we had an enormous stock market rally in the Dow, 1,300 points. It was up, absolutely incredible. And I think a lot of people were buying the rumor, selling the news, expecting that rate cut. That was the emergency rate cut, really, because there is no Fed meeting. The Fed meeting, what is at the end of March? I didn't look up the Fed's exact March meeting on their calendar, but according to Jim Bianco of Bianco Research, there is supposed to be another emergency cut coming. So the market is pricing in another 25 basis point rate cut already. It's over 100% supposedly. Lots of people are betting on it. A lot of financial professionals in the Fed funds rate are betting on it for the next Fed meeting end of March. So this was a meeting that was done. This was a rate cut, that was done, that was not scheduled. And the last time we had an unscheduled rate cut was, drum roll please, the 2008 financial crisis. The last time we had an unscheduled rate cut was the 2008 financial crisis. Also, as I will talk about, there are a lot of similarities with the junk bond market in the last 10 days to 2 weeks, and the global credit markets seizing up very, very similarly to November 2018 and December 2018, which was the last time the plunge protection teams, US Treasury Secretary Steve Mnuchin, the Federal Reserve, all of the alphabet soup of banking regulators all had to have at least one emergency meeting because the press release was sent out on Christmas Eve 2018, so December 24th, 2018, that there was an emergency meeting because of how much credit markets froze up. And guess what? We just had another one start last week. So a number of different reasons, in my opinion, for the rate cuts today. Obviously trying to goose the stock market higher, but also uninvert the yield curve. So the yield curve, a lot of professionally managed money, in my opinion, these are guys that would normally be long stocks, are now fading the stock market rally. There was a lot of stock market traders and professional money managers, institutional investors, that bought the rumor on the rate cuts and sold the news. So they bought the rumor about the rate cuts. The market was pricing in the rate cuts already yesterday, and that was the rally, at least part of it maybe. And they sold the news today. And also, I think from what I've heard from Dave Cullum, and people are like, why do you interview Dave Cullum? He's a chemistry professor that he writes along stock market review and markets review every year, and he goes on these kind of crazy half-baked long rants. And well, most people aren't aware of that guy's contacts list. I mean, he is really good friends with David Einhorn. He speaks a lot to David Einhorn in emails, and Einhorn's does not like doing a lot of public interviews. I think I've seen maybe one or two podcast interviews in the last year from David Einhorn. He did a brief one on the Jelly Donut podcast. I don't know how he got that. Pretty amazing that he got David Einhorn on for 20 or 30 minutes. So Dave Cullum gets information from David Einhorn and other very high level professional money managers. We're talking institutional level guys. So these are the guys that manage on Wall Street billions of dollars. Dave Cullum knows some of these guys. And apparently what's been going around now is a lot of these professional money managers, I don't know specifically if it's Einhorn, but Dave Cullum has been tweeting about this, others have too, that a lot of professional money managers on Wall Street that manage billions of dollars have no faith in President Trump to properly manage, along with the CDC, this very complicated, very difficult quarantine and dealing with this is going to get demonetized anyway, because one of my listeners said that YouTube and Google can actually read the text on the screen there. They can see on the article that global credit markets have frozen up due to coronavirus, has halted bond sales. So they can see that on the screen. This video is going to get demonetized anyway. So thankfully to my Patreon account contributors, which are growing very, very rapidly now, a couple per day, it doesn't really matter. But a lot of professional money managers on Wall Street are fading rallies. The confidence game is lost. A lot of professional money managers who manage billions of dollars, hedge fund guys, institutional investors, you know it's a bad sign when the rate cuts don't juice the market normally. When people are selling the rallies, fading the news, fading the announcements. So that is a bad sign. Okay, so there is professional money managers now selling the stock market rallies. Every time their rally happens in the major stock market indexes or large stock, they're selling the rallies. Probably why also Jeff Bezos sold a bunch of stock, a couple weeks ago or a month ago? He was cashing out some of it, $4 billion or something like that? The dollar index is down barely above 97 now. So the dollar index may have been pricing this in. Also, I have another theory on the dollar index too. And I'll talk about that. That's with global credit markets seizing up. So the VIX also spiked 10% today after getting hammered. The VIX is back up above 35 at 36.82. I think a lot of professional money managers are going into gold, and they're going into treasuries. Because the 10-year US Treasury, is it below 1 now? It's right at 1. It's 1.01. Yeah, so there's a lot of managed money that's going into treasuries. But the rate cuts that were done, combination to help the stock market and try to uninvert the yield curve. There's probably other reasons too. But I think the stock market was pricing in the dollar index was pricing in some of that last week. Now you would think with gold going in a crisis event, you would think that the dollar would also be strong. Money would be going into gold and treasuries. However, that's not happening this last week or so. So it's very interesting. The question then is, why is the dollar not also rising? And I think it could be, this is my theory, I obviously can't prove this because there is no audits, independent audits of central banks, especially the Federal Reserve, with their currency swaps. But I think the currency swap spigot, those massive amounts of currency swaps, the hoses that the Fed put out in 2008 and 2009, and initially with the Ron Paul one-time partial audit that he got the Republicans and Democrats in Congress, that includes Bernie Sanders and John McCain, to actually agree on a one-time partial audit. We found $16 trillion worth of currency swaps, interest-free loans given out to foreign governments, foreign central banks, foreign private banks, foreign corporations, multinational corporations here in the U.S. and abroad, etc. And I think that currency swap spigot could have been turned on again. And I think this has to do with what my friend Daniel Lacalle has been talking about for years, also the Bank of International Settlements, and zombie companies. So there were a lot of zombie companies prior to the global supply chain getting decimated by the coronavirus. Now, I think my educated guess is we're already, the banking system, a lot of banks, probably in Europe, but probably Chinese banks, probably emerging market banks. The U.S. banks are probably going to start feeling this soon if they haven't already. But I think a lot of banks are starting to feel the heat with the credit lines, the revolving credit facilities, the debt covenants, with a lot of these companies that are in the global supply chain. So I think there is companies that are late on payments, not making payments. And I think the Fed, with the weakness in the dollar before the rate cuts, I think it more than the market pricing in the rate cuts last week while the dollar was weak, I think this has more to do in my opinion, with the fact that the currency swap spigot has been turned on, which means that there are more dollars floating around out there to prevent the whole system from freezing up and crashing. And the evidence I would cite with my educated guess here for this thesis would be global credit markets are freezing up, with the article that you can see there on your screen. So I'm trying to put the pieces to connect the dots and put the pieces to this puzzle together. And I have not heard a lot of people talk about the global credit markets seizing up again. I think it is very important. So as crazy as all the volatility in the US stock market is, and now it looks like professional institutional investors, professional money managers, hedge fund guys no longer believe the con game, the confidence game that President Trump has about dealing with the coronavirus, because they think that, look, I mean, the Q1 earnings for a lot of companies, the revenues and the earnings for a lot of companies in the global supply chain, unless you're Costco or Clorox, Clorox is going to mint money. Costco and Clorox are going to absolutely, the valuations on those on Costco were insane already. I remember at Investing Daily when I was when I was working in Investing Daily as an analyst in 2013, and Costco was $110 a share back then. This was 7 years ago. And the people, my bosses, were telling me, you can't write an article on Costco, it's too expensive. And so I wrote an article on Costco at $110 a share. It's up more than threefold now, 7 years later. Anyways, unless you're Costco or Clorox, and where, by the way, I just went on a let me just, quick anecdotal story here, go off tangent. I just did a Target run today, and I put videos on my Twitter, and the shelves are totally empty for hand sanitizer, for antibacterial soap, all the Clorox wipes, all the Lysol wipes, all gone. There is nothing there. Someone came in and cleaned them all out. I had to go to 2 Targets within 15 minutes of each other because I really needed one thing I had to buy, and the one of the Targets didn't have it, and it was like the same story for hand sanitizer and antibacterial soap and Clorox wipes and Lysol wipes at the other Target. But thankfully the other Target did have the one thing I needed, but it didn't have any of those wipes. Okay, anyway, back to this the credit market freeze up. The last time this happened was when we almost had a 20% stock market crash, November 2018, December 2018, and there had to be a ton of interventions and other crazy stuff behind the scenes. Remember, the Fed back then was raising rates, and they had just started quantitative tightening or balance sheet reduction. So let me talk about this story, even though it's going to get demonetized because it says coronavirus in the actual title of the story. And apparently, according to one of my listeners who emailed me, Google and YouTube have this software that can read the word coronavirus there on your screen and are going to demonetize the video, even if I didn't mention the word coronavirus. Good job, Google. Good job, YouTube. Okay, so the global credit machine, this was from February 26th. Hannah Benjamin, Tassos Vosos, Molly Smith are the writers. The $2.6 trillion international bond market, where the world's biggest companies raise money to fund everything from acquisitions to factory upgrades, came to a virtual standstill as the coronavirus spreads fear through company boardrooms. In the US, Wall Street banks recorded their 3rd straight day without any high-grade bond offerings, a rarity outside of holiday and seasonal slowdowns. European debt bankers had their first day of 2020 without a deal on Wednesday, and bond issuance in Asia, where the virus first emerged, has slowed to a trickle. It has been a remarkable turn of events for a market where investors had been snapping up almost anything on offer amid a global dash for yield. And I'll add this here, thanks to governments, large governments, and many central banks doing financial repression or Japanification, stealing interest income from retirees, pension funds, and regular people on Main Street to turn us more into even worse serfs. Europe had been enjoying its strongest ever start to a year for bond issuance, because the Europeans, I'll add this here too, because the European Central Bank was buying them all up. So, of course, there would be record bond issuance because the European Central Bank is buying them all. So if you know the European Central Bank is going to buy them all up, why not issue more? Welcome to dystopia. You can't make this shit up. Okay, end of rant. ever to start a year for issuance, and sales of U.S. junk bonds had been on the busiest pace in at least a decade. With so many borrowers having postponed their issuance plans, a calming in global markets could kickstart debt sales again. An informal survey of U.S. high-grade bond dealers on Wednesday indicated that strong companies with good name recognition among investors may try to sell debt Thursday if conditions improve. Buyers have been there all along and will be ready to digest the new bond supply if companies proceed, the dealer said. Credit investors have been rattled by the potential impact on company earnings from disruption caused by the coronavirus, which has seen huge parts of global supply chains shutting down. While markets have yet to see any panic selling, a derivatives index that gauges credit market fear in the U.S. had its biggest jump in more than 3 years on Monday as investors rushed to hedge against a wider sell-off. Quote, it's a coin toss as to what tomorrow will look like, or even the rest of today. Okay, I'll skip that part. Honeywell International, Virgin Money UK, and Transport for London were among the European borrowers readying deals before financial markets turned hostile. Before the slowdown, Europe had seen 239 billion euros, or about $260 billion, of bonds sold just in the month of January 2020 alone. The U.S. investment-grade market was expecting around 25 billion of bond sales this week, which was last week. The article was from last week, before coronavirus fears froze the market on Monday. Excluding the December holiday season and typical 2-week summer hiatus in late August, there hasn't been that long of a break to start the week since July 2018. That was a Freudian slip. Remember, everything almost crashed in 2018 because the credit markets froze up first, and the Fed was raising rates, and the Fed was reducing its balance sheet. So the global offerings also came to a halt in the U.S. junk bond market, where $67 billion of sales had been running at the fastest pace since at least 2009, data compiled by Bloomberg shows. The mining company Cleveland Cliffs, say that 3 times fast, also say Naranja Kocher Lakota 3 times fast. Sought to break the issuance freeze late Wednesday, testing investor demand for... I had to practice Naranja Kocher Lakota to say that right, by the way. Testing investor demand for a $950 million offering of secured and unsecured notes to refinance of an acquisition target's debt. And the Canadian market remained open for business as utility company Hydro One raised about 1.1 billion Canadian, or 827 million, in the largest Canadian dollar bond from a non-financial company this year. It's a sharp turnaround for private corporate bond markets around the world, where demand has triggered supply against the backdrop of 14 trillion of negative yielding debt globally. So remember, the amount of negative yielding debt was as high as 17 trillion, so it's down quite a bit, although I suspect it may get even worse than that now, if they're going to keep lowering interest rates, the U.S. is. In the U.S. investment-grade market, $220 billion had priced this year through last week, running about 19% ahead of last year's pace. Until this week, European issuers had brought at least 30 billion euros worth of sales for the past 6 weeks in a row. Wow, that's a lot, because the European Central Bank, is buying them all. While a dearth, also professional bond fund managers who have to buy something. They have to hold their nose and buy something. While a dearth of supply is usually a positive technical for the market, all else equal, spreads have widened as demand has fallen off as well. Borrowing premiums on euro-denominated debt jumped to 95 basis points more than government bonds this week, the highest in 2020, according to Bloomberg Barclays Index. The U.S. index climbed to 107 basis points, the most since November. U.S. high-yield bonds haven't been this cheap on a spread basis since October, but they're still not an attractive buy given caution on earnings calls, according to Citigroup strategists. Let me add what Jeff Gundlach said. So in the last 10 days, Jeff Gundlach put out a tweet that a lot of professional investors are going into treasuries and selling their junk bonds. So the spreads between what is viewed as relatively safer U.S. treasuries and junk bonds has soared. And there are a number of articles out in the last week about junk bond issuance stops dead in its tracks on coronavirus fears and enormous record outflows out of the 2 major junk bond ETFs. Let me pull this up here. The 2 major junk bond ETFs to watch are JNK, the Spider Bloomberg Barclays High Yield Bond Index, and the HYG. So you have James, Nick, Krispy Kreme. I don't eat donuts. I don't know why I'm thinking of Krispy Kremes. It must be because I don't have much carbs and sugar anymore. Okay, HYG, and then so HYG is the other junk bond yield index. The iShares, iBox, Dollar High Yield Corporate Bond ETF. So HYG, Harry Harry Y, and then Greg. Off the top of my head, I could not think of a word with Y. There was record outflows last week out of junk bond yields, which is bad for credit issuance. Last time this was 2018. Okay, now let me talk about the statement from the G7 finance ministers and central bank governors. So this was the conference call that was today. We G7 finance ministers and central bank governors are closely monitoring the spread of coronavirus disease and its impact on markets and economic conditions. Given the potential impact of COVID-19 on global growth, we reaffirm our commitment to use all appropriate policy tools to achieve strong, sustainable growth and safeguard against downside risks. Alongside strengthening efforts to expand health services, G7 finance ministers are ready to take actions, including fiscal measures where appropriate, to aid in the response to the virus and to support the economy during this phase. G7 central banks will continue to fulfill their mandates, thus supporting price stability and economic growth while maintaining the resilience of the financial system. We welcome the International Monetary Fund, the World Bank, and other international financial institutions to stand ready to help member countries address the human tragedy and economic challenge posed by COVID-19 through the use of their available instruments to the fullest extent possible. The G7 finance ministers and central bank governors stand ready to cooperate further on timely and effective measures. Okay, so this sounds like a bunch of gobbledygook. What this means to me is that they're coordinating a lot behind the scenes. Jerome Powell said as much in his press conference today. I did watch part of it. I think it was around 11 a.m. Eastern time. I saw a pretty good chunk of it. And he said that there was quite a bit of coordination behind the scenes. So it wasn't just one meeting. I think the currency swaps have turned back on. And I think this has to go with what the Bank of International Settlements, the IMF, and World Bank have been warning about way before the coronavirus. The amount of zombie companies that are already in the global economy in the US and Europe. Chinese companies with dollar-denominated debt problems. Lynn Alden wrote a great article last week called The Global Dollar Short Squeeze. I'll put it in the information and description section. So I think what is happening and why there are these emergency meetings, yes, the Fed cares about the stock market, but the Fed cares more about the bond market and credit issuance. So right now, yields for US Treasuries are going down, so that's not a problem. The problem seems to be what the stories came out last week with credit issuance and junk bonds. So I think what's happening, my educated guess, is there's a lot more companies with supply chain problems than we know, or they're not disclosing it. And the banks are getting maybe defaults, at least late on payments, but defaults, and the banks can't handle it. And in the central banks, a lot of this defaults and loans are in dollar-denominated debt. Which means if the global economy has too many zombie companies already, and there's either new zombie companies thanks to the global supply chain and the coronavirus wreaking havoc, or those existing zombie companies before the coronavirus, before the supply chain problems getting worse and the supply chain wreaking havoc, they're even worse zombie companies. So the defaults are spiking, and that's hurting the banks. And a lot of the problems are with this 24 trillion in the 24 trillion total the number that I've said is just adding up the amount of dollar-denominated debt that the Bank of International Settlements listed in their global macro report, December 2019, and then also the amount of derivatives for the forward dollar swaps. So that's about at least 24 trillion total in dollar liabilities. Just call it dollar liabilities rather than going through what's a forward dollar swap. You don't need, if you're a regular person, you're not a financial professional, it's a dollar liability. It's games that these foreign governments and foreign central banks and foreign banks played, betting on the dollar to crash a lot faster than it has. Well, the dollar hasn't crashed, but betting on the dollar to have collapsed, like Peter Schiff's thesis for years now. So they borrowed as much dollars as they can, betting that the dollar would collapse quickly, and it did not. There were other reasons why they borrowed in dollars. The yields, the amount of interest that they would pay in the short term would be cheaper, but they were taking on immense currency risk because they They had to earn, the companies earned in their local currency, and then had to pay back the bonds in dollars. So there was enormous currency risk, and a lot of these dollar bonds were unhedged. So they had unhedged currency risk. So if their currencies fell a lot against the dollar and they had to pay back in dollars, they were in trouble. And I've been saying this for a while, if the dollar shortage and dollar denominated debt and dollar bonds started defaulting rapidly, that's when the Fed, out of desperation to maintain the system, would start opening the spigots again with the currency swaps. Because the currency swaps are access to dollars. So I think there's at least some anecdotal evidence here that the currency swap spigot is already opened up again. I don't know how much. I don't know if we'll ever know how much. But I suspect the currency swap spigot started by the action in the dollar last week. Okay, got a few super chats here. Let me take a look at that, and then I'm going. Okay, got a super chat from Justin March. Thank you very much for the super chat. I appreciate it. Got a super chat from Greg. Thank you very much, Greg. I appreciate it. I think a lot of professional money managers have lost confidence in President Trump, the Trump administration, the CDC, to handle the coronavirus here in the US. And it's not all Trump's fault. The CDC was a mess before Trump. Let's just put it that way. All these federal government agencies have enormous personnel problems that an unlimited budget probably couldn't fix for all of them. Let's just put it that way. The problems with a lot of these federal government agencies are immense. So budget problems, which are often cited by Democrats when Republicans try to cut budgets, are not the main problem. Okay, got a couple more super chats. Let me take a look at this here. D's nuts. Thank you for the super chat. Okay, you're at work. Okay, I won't tell QTR what you said. I won't repeat what you said. Okay, Soylent Goy. Thank you for the super chat. He says, how long until you scroll through stories on screen? You must not be familiar with my policy. There was a lot of people that have been complaining over the last week or two that I need to shorten my live stream shows by 20, 30 minutes because the 40, 50-minute shows were too long. And honestly, me answering questions for 20, 30, 40, 50 minutes for free when a lot of the questions are the same and they take a lot of time for me to think, and often it's off the cuff and I can't come up with a great answer. It's just easier for me to take the time to either write an article or do an audio podcast and then put it behind the paywall on my Patreon account. I can't answer. There's literally dozens and dozens of questions here. I can't answer all of them. I'm not getting paid to answer all of them either because these videos are being demonetized now. I've had 10 videos demonetized in the last 14 days. So sometimes what'll happen is YouTube will run the ads for an hour or two after I'm done with a live stream show, and then it'll be demonetized, or it'll be demonetized immediately. Thankfully, a lot of people are chipping in $5 a month for the content behind my Patreon account paywall. It's almost 400 now. It's rolling. Getting a couple signups per day. So I will not be answering nearly as many questions in the live chat. I'm not going to be spending 30, 40, 50 minutes answering questions for free. When the video is going to be demonetized, I'm not going to make any money on that, and I need to pay the bills. I may do separate shows where I answer some live chat questions. I may do something like that, or for Patreon account contributors, what I can do maybe is like an Ask Me Anything or some type of something like that. I may be able to do something like that. I'll think about it. Okay, got another super chat here from Dimitri. Thank you very much, Dimitri. Dimitri, are you a Patreon account contributor? There is a lot of stuff behind the paywall. Okay, why did miners reverse course? Let me look at the mine stocks. The mine stocks had a nice rally. I think some professional money managers are now selling general stocks and they're accumulating gold and gold stocks. But it depends. I talked about this in an audio podcast behind the paywall in more detail. It depends if we just go to regular risk off, and regular risk off, in my opinion, would include mining stocks, gold mining stocks, and silver mining stocks. And extreme risk off is different than regular risk off. So for professional money manager, extreme risk off would mean no gold stocks. It would mean gold exposure to maybe like GLD or one of the Sprott physical gold trusts or Central Fund of Central Fund of Canada. Would mean maybe exposure to that or buying physical gold, but it would mean no gold stocks. So it depends if we go into a regular risk off environment, which I think in my opinion includes gold stocks, or an extreme risk off environment. But it is interesting, though, that the dollar, which was rising up until towards the end of last week, the dollar index had been on a big tear above 99 for a while. So from like February 12th until towards the end of last week, so for I think more than 12 days, the dollar index was above 99, which to me, with gold rising and the dollar index above 99, was signaling maybe the increasing likelihood of a crisis event. So in a crisis event, the dollar and gold will rise together. Oh, thank you, Bob, for the super chat. I appreciate it. Jonathan says there are already runs on Chinese banks. There might be. They've had big spikes in their repo market. There was a really good buying opportunity for Sandstorm Gold. It dropped below 6 briefly for a day or two. It was like at 580, 590 per share in US dollars. That was a bargain there. There was some really good deals. Pan American Silver, which I think is the best run silver company, not First Majestic Silver. I'll talk about why maybe in a audio podcast behind my Patreon account paywall for $5 a month. Okay, well, that's it for right now. I want to thank everyone for listening. Go back and listen to this if you want to hear me put the pieces to the puzzle together. So everyone's paying attention to the stock market volatility. Yes, the stock market is going to be very volatile. I think a lot of professional money managers have no confidence in President Trump and the Trump administration and federal government agencies who are not Trump supporters, by the way, have no confidence in the CDC and others to handle this coronavirus properly. So they expect earnings. They expect this to have a lot of problems here in the U.S., which is going to hurt company earnings. So I think a lot of professional money managers, hedge fund guys, institutional investors are fading this rally now. And I think they're going to treasuries and gold stocks. Sean says, give us a paywall behind YouTube. The problem with that, Sean, is YouTube takes 50%. So YouTube takes 50%. YouTube already takes enough, okay? YouTube already is, the harder I work, the more content I make, the less ad revenue I get. And now it's demonetized the last 14 days. So I was, my channel was growing extremely, got tongue-tied there. My channel was growing extremely rapidly, and my ad revenue was actually falling since August and September of 2019. So the more my channel grew, the less money I made. Does that sound like a smart business venture to you? And behind YouTube's paywall, they take 50% of it. Whereas PayPal, I think, takes a couple percent on my monthly PayPal, and Patreon takes 5%. Right now, YouTube's my loss leader. I don't make any money from it. I made a little bit. I only had like 4 videos in the last 2 or 3 weeks that actually ran any ads. Okay, well, I want to thank everyone for listening, and definitely check out my Patreon. It's only $5 a month. There is a lot of articles, written articles, audio podcasts, and some chart work behind the paywall there. I'm offering it way below what it should at $5 per month. I think it's a good deal. You can try it out. Eventually, I may put more high-level premium content there at a higher price point, but for now, it's staying at $5 a month to start with. Thank you very much to my Patreon account contributors, my 10 or so monthly PayPal contributors, and people who tip me once in a while with some cryptocurrency. It's much appreciated. We're all doing what we can to survive. This is a mess. Behind the scenes, I think a lot of crazy stuff's going on behind the scenes. Because, I mean, the stock market was not even in a bear market. And here we have this emergency G7 meeting with finance ministers and central bankers. And again, I think this goes back to the credit freeze last week and goes back to the dollar shortage. And I think the banks in Europe, emerging markets, and China are all getting massive amounts of defaults from zombie companies. Either existing zombie companies that are getting worse or new zombie companies.